Hello and welcome back to the channel. My name is Zach Collins and this is Financial Education. For those of you that don't know me, what is my background? I was a financial advisor in my past, fully licensed, fully FASF compliant, specializing in both super and non-super investments. I'm not licensed anymore, but I would love to get my license back one day. I left the industry as I couldn't stand the owner of the business and I've got no interest in sales. It's not all sales, but my passion is to help people, not to sell various managed funds or insurance products. These days, I work in tax and compliance. Let's get into it. Today, I want to show you guys how wealthy groups tend to structure their groups. When it comes to groups, what is a group? So a group is any entity that is linked directly to you. Most people do not have any other entities. However, a group could be as simple as you and your partner. You might then expand your group as you build your wealth and have an SMSF, for example. Then you'll be a three-entity group. You might want to start investing any surplus wealth through a trust, and that would be linked to the group. If the trust starts to generate more income than you're expecting, you might then start a company and use that as a bucket company. Its only operation is to receive the trust distributions and invest that income in a lower tax bracket than if it was paid out directly to you. In this scenario, you're looking at five entities. You've got yourself, you've got your partner, you've got an SMSF, you've got a trust, and you've got a company, making five. This is not necessarily the standard, but is one formation of a group. I'll go through two large groups that I've had involvement with and talk about how they were organized and what the pros and cons were for each of them. Let's start with Group T. Why am I calling it Group T? Because you'll see in a moment, it's basically made up entirely of trusts. So let's start with the basics. So they had two individuals, the guy and his wife, and they had an SMSF. And the children were also members of that fund. Simples. Next, we come to the business side. They had one company entity. And this company acted essentially as the controlling management of the whole group. Its income was from management fees and the operations that it provided to the rest of the group. The rest of the group was all trusts. So let's say the group was in sales. It sold widgets. Each shop fund that sold these widgets was owned by the group. So let's say there was one trust that ran the operations for each stores that sold the widgets. Let's say they got 5 stores, so it's 5 trust entities. They also had one construction arm. They would build the stores. They had a few entities as well that they would act as staffing. So they would contract the staff out to the stores. Let's say that's one per store. So now we've got 5 different staff trust entities. Finally, we've got 2 entities that owned all the land that the group operated on. So let's count that all out now. So you've got 2 individuals. You've got an SMSF, you've got a company, and you've got 13 trusts. Sounds like a lot of entities, and it is. To make it more complex, for trusts, you can have either an individual trustee or you can have a corporate trustee setup. Now, this group had fully corporate trustees, so that's another 13 companies. I mean, bear in mind that these entities don't actually do anything other than act as trustees. So from operations standpoint, they don't matter, but from a group standpoint, it significantly increases the complexity. Why, you might be thinking why the group would have so many trusts. Now, if it's done correctly, which this group didn't, and I'm not going to go into the legal side of it, but if it's done correctly, it would have been able to transfer profits from the various entities into other entities of the group that were making losses. Why would you want to do that? To not pay any tax. What they were able to do was have substantial loans between various entities, including the individuals. So when companies loan money to individuals, there's something called Div 7A. Now, trusts don't have Division 7A. So trusts can lend money to any entity and they can charge them no interest. And that is perfectly legal. So this group had significant intergroup lending. We're talking well over $200 million. And most of this was interest-free and it was perfectly legal. Let's move on to the next group. And we'll call this group Group C. Why? Because this group was pretty much the opposite of Group T, and that was entirely comprised of companies. This group was also made up of 2 individuals, but unlike Group T, these guys did not have a super fund. Not sure why. It's a super wealthy group. Let's say they got 200 mil in net assets. But for some reason, their super funds were like, they got 10K in super. which makes no sense given that low tax jurisdiction of super, but you do you, mate. Anyway, so they had two consolidated companies. What does this mean? It means that you have a whole heap of companies. Each one is involved in the same industry, but different parts. But all of the various companies were owned by one head company. Because the head company owned 100% of the shares in all these subsidiary companies, they're basically able to consolidate their financials and the tax returns. They had 40 or 50 different companies, all consolidated under the two main groups. Next, they had two trusts. Now, these two trusts, each trust owned the different consolidated group. And as in the last group, the trusts used corporate beneficiaries. Now, this group had a lot of issues. They had lots of interlending agreements, again, similar to Group T. However, they also loaned money to the individuals in the group, which is a massive red flag, and Division 7A issues. Similar to how Group T was distributing profits from one trust to another that had made losses, Group C was doing something similar. When you consolidate multiple companies into one, what they're able to do is each consolidated entity is able to use the losses of the companies within that consolidated group. And so they're able to offset the profits of others with losses of others in the group. So overall, the consolidated group might have a slight loss or slight profits, and they're able to use up the various losses and profits of the different entities to end up paying no or very little tax. Now, both of these different groups, they're pushing the boundaries of what you can do. Group T was probably the best from an operational standpoint and the distribution of profit and capital. Group C was very convoluted, and the way they structured it resulted in a ton of Division 7A, which is not something you want, and it can heavily increase your tax payable if you found to breach those laws. Now, every group in Australia, they're bound to have a different structure. And look, these are two extremes. Maybe one day when you're laying out, how you want your group, you can look and use these as references. Hopefully, I have been able to give you a bit of a better understanding how different groups structure their entities and have some ideas about how you might structure yours in the future. If you've got any more questions, please feel free to drop a comment below and I'll answer if I can. Thank you so much for watching, and I'll see you guys in the next one.